Most investors think they understand what just happened to gold. They don't. On January 30th, 2026, gold crashed 11% in a single day. Silver dropped 28%. $250 billion in wealth vanished in 72 hours. But here's what nobody's telling you. The same forces that caused this crash are about to create the biggest wealth transfer in precious metals history. Stay with me, because what I'm about to show you will completely change how you think about gold, central banks, and your money. Let me paint you a picture of where we are right now. February 2nd, 2026. Gold is trading at $4,668 per ounce. Just 4 days ago, it hit $5,608, an all-time record, a price that would have seemed impossible 2 years ago. Then came the announcement that nobody saw coming. President Trump nominated Kevin Warsh as the next Federal Reserve Chair, and the market absolutely collapsed. Gold plunged 11% in one session, the steepest drop in over 40 years. Silver got annihilated, down 37% at one point. Mining stocks, Barrick Gold fell 15%. Pan American Silver dropped 25% before bouncing. The VanEck Gold Miners ETF crashed 13%. Junior miners down 18%. In those 72 hours, $250 billion in market value just evaporated. Trading volumes exploded. On January 26th, the CME Group processed 3.3 million gold contracts in a single day. That's a record. More volume than any day in gold's modern history. The market had no depth. Small orders were moving prices by $20, $30 per ounce. Bid-ask spreads, normally tight, widened by 300%. This wasn't normal volatility. This was panic. But here's what you need to understand. While retail investors were selling in terror, while speculators were getting margin called, while the media was screaming about the end of gold's bull market, central banks didn't sell a single ounce. Not one. In fact, they've announced plans to buy 755 tons in 2026. That's $35 billion worth at current prices. And that disconnect, that's the opportunity almost nobody is talking about, because what just happened wasn't the end of anything. It was a reset, a violent, painful, necessary reset that's setting up the next phase of gold's move. And those who understand what's really happening, they're about to position themselves for the opportunity of a generation. Now, I know what you're thinking. You've seen gold rallies before. You've seen them end badly. 2011, right? Gold hit $1,900 an ounce. Everyone was euphoric. Then it crashed to $1,050 by 2015, a 45% collapse that destroyed fortunes. Mining stocks, they fell 85%, 85%. People who thought they were buying insurance ended up losing everything. So yeah, I get the skepticism. I understand why this crash has you worried. But here's what most people miss. History doesn't repeat. It rhymes. And the rhyme we're seeing right now, it's not 2011. It's much bigger. In 1980, gold hit $850 an ounce. Inflation was raging. Interest rates were at 20%. Paul Volcker at the Fed broke the back of inflation by choking off the money supply. Gold crashed, down to $250 by 2001, a 70% decline that lasted 2 decades. That's what people remember. That's the ghost that haunts every gold bull market. But look at what happened next. From 2001 to 2011, gold rallied from $250 to $1,900. That's a 660% gain in 10 years. And it wasn't driven by retail investors or speculators. It was driven by central banks waking up to a new reality. The US dollar was being systematically devalued. The 2008 financial crisis exposed massive structural flaws in the global financial system. So central banks started buying China, Russia, Turkey, India, Kazakhstan. They accumulated thousands of tons, quietly, methodically, regardless of price. Now look at today. From January 2025 to January 2026, gold gained 259%, more than doubled. Silver up 146% in 2025 alone. Then another 55% in January 2026 before the crash. These aren't normal numbers. These are panic buying numbers. But here's the critical difference between now and 2011. In 2011, central banks bought 400, 500 tons per year. That was considered aggressive. In 2025, they bought 863 tons. In 2026, they're projected to buy 755 tons. That's 60% more than the 2011 era average. And here's the part that should terrify you. 95% of central bankers surveyed say they expect gold reserves to increase in 2026. 0%, not one single central banker, expects reserves to decline. Do you understand what that means? The institutions that control $12 trillion in foreign reserves have decided gold is essential, not optional, essential. That wasn't true in 2011. It wasn't even true in 2020. This is new, this is structural, this is unprecedented. And that's why this crash isn't the end. It's the beginning of something much bigger. Now, you don't have to take my word for it. Let's talk about what the people who actually move markets are saying. JP Morgan, not exactly a gold bug institution, released their 2026 forecast in December. Their target, $5,055 per ounce by Q4 2026. Goldman Sachs, $5,200. These aren't fringe analysts. These are the banks that manage trillions in client assets. Here's what Natasha Kaneva, JP Morgan's head of global commodities strategy, said, and I quote, "While this rally in gold has not and will not be linear, we believe the trends driving this rebasing higher in gold prices are not exhausted. The long-term trend of official reserve and investor diversification into gold has further to run." Let that sink in. Has further to run. She's not calling a top. She's saying we're in the middle innings. Gregory Shearer, JP Morgan's head of base and precious metals, pointed out something fascinating. In Q3 2025, investor and central bank gold demand totaled 980 tons. That's 50% higher than the previous 4 quarters. But here's the kicker. From a dollar perspective, that 980 tons represented $109 billion in demand. That's 90% higher than the average of the previous 4 quarters. Not because volume increased 90%, because prices doubled. Now, what did Kevin Warsh's nomination actually change about those fundamentals? Did central banks suddenly trust the dollar more? No. Did geopolitical tensions decrease? Absolutely not. Did U.S. government debt magically disappear? The debt's at $35 trillion and rising. So what changed? Sentiment, psychology, fear of missing out became fear of losing everything. That's it. That's the whole story. The fundamentals? Still intact. Let me give you another voice. The National Bank of Poland's management board member, Artur Soboń, made a statement that should be written on every investor's wall. He said, "Our primary goal is to build an appropriate portfolio for these unstable geopolitical times, one that will guarantee Poland's stability, security, and credibility. The price is not a primary consideration for us." Read that again. The price is not a primary consideration. Poland added 102 tons of gold in 2025. At prices ranging from $2,800 to $5,300 per ounce, they didn't care. They kept buying, and they've announced plans to buy another 150 tons by 2027. That's $23 billion at current prices. For Poland, that represents 3% of their entire GDP. That's not a trade. That's a strategic decision about national survival. Now, here's where it gets interesting. Thierry Wisman from Macquarie Group made an observation about Kevin Warsh that Wall Street whispers about but won't say publicly. Warsh is not the Fed's guy, he is Trump's guy, and has shadowed Trump on monetary policy almost every step of the way since 2009. Think about what that means. Warsh was a hawk in 2011. He opposed QE2. He warned about market distortions. But since 2009, he's echoed Trump's desire for lower rates, for easier money. So the market's betting on a hawk who might actually be a dove in hawk's clothing. That's why FX Empire analysts are saying this pullback is a reset after an extended rally, rather than a change in broader trend. The structural factors supporting gold haven't changed. They've intensified. This next part matters, because it's the part almost nobody is talking about. Let's talk about something that should keep you up at night: gold production. The supply side of this equation. Global mine production has been flat at 3,500 to 3,600 tons per year since 2019, despite gold going from $400 to $5,600. That's not normal. When prices triple, production should surge as high-cost mines become profitable, but it hasn't. Why? 3 reasons. First, ore grades are declining. In 2010, the average gold mine processed ore with 1.2 grams of gold per ton. By 2025, 0.9 grams per ton. That means miners have to process 33% more rock to produce the same amount of gold. More energy, more labor, more environmental impact, higher costs. Second, new discoveries have collapsed. In the 1990s, the industry discovered 20 major deposits exceeding 5 million ounces every year. From 2020 to 2024, only 3 deposits that size were discovered. Total, in 5 years, the easy gold is gone. We've picked the low-hanging fruit. Third, development timelines are insane. From discovery to production, 7 to 15 years, minimum. You need to explore, drill, complete feasibility studies, get permits. That alone takes 3 to 7 years in most jurisdictions. Secure financing, build infrastructure, commission the mine. So even if gold stays at $5,000 per ounce for the next decade, you won't see a meaningful production response until the 2030s. That's supply constraint at a fundamental level. Now let's talk demand. Central banks, 755 tons projected for 2026. That's $35 billion. India expected to import 700 tons. That's $32 billion. China officially reported 401 tons in 2025. But researchers estimate actual purchases could be 2 to 3 times higher when you include unreported state buying. ETF demand. U.S. listed gold ETF inflows hit $37 billion through September 2025. Daily trading volumes reached $208 billion in October, a record. Gold bar and coin investment doubled year over year globally. Add it all up, and you're looking at 3,500 to 4,000 tons of annual demand against 3,600 tons of supply. That's why recycling matters. In 2025, approximately 1,100 tons of gold came from recycled jewelry and scrap. Without recycling, the market would be in massive deficit. But here's the problem with recycling. It's price sensitive. At $500-600 gold, people sell their old jewelry. At $4,700, less so. So as prices correct, recycling supply decreases, tightening the market further. This creates what traders call a supply-demand pincer. Limited primary supply, strong price inelastic central bank demand, growing investment demand. That's not a recipe for lower prices. That's a recipe for volatility around a rising trend. And here's the crucial point that most people miss. Every correction creates pent-up demand that gets released when prices stabilize. Think about it. If you were planning to buy gold at $5,400 and it crashes to $4,700, what do? You buy more. You accelerate your purchases. You see it as a gift. That's what central banks are doing right now. That's what sophisticated investors are doing. They're not panicking, they're accumulating because they understand something that the retail seller doesn't. This isn't 2011. The supply-demand dynamics are completely different. All right, let's talk numbers. Real scenarios with actual logic. I'm not going to tell you gold is going to $10,000 next month. I'm not going to give you moonshot predictions with zero basis in reality. What I'm going to do is walk you through 3 scenarios, bullish, base case, and risk case with the actual math and probability distribution. Base case, 5,055 by Q4 2026. This is JP Morgan's target. It assumes central banks buy 585 tons per quarter, 340 tons for the year. Geopolitical tensions remain elevated but don't dramatically escalate. The Federal Reserve holds rates steady through mid-2026, then cuts 50 to 75 basis points by year-end. U.S. dollar remains in a 95-100 range on the GDXJ index. Investment demand stays at 2025 levels. Under this scenario, gold trades in a $4,500-$5,300 range through most of 2026, ending the year around 5,055. That's an 8% gain from current levels. Not spectacular, but solid. But here's what that means for mining stocks. Barrick Gold, with AISC of 1,387 per ounce, would be generating $3,668 per ounce in operating margin. At 4 million ounces of production, that's $14.6 billion in operating cash flow. The company's current market cap, $32 billion. They'd be generating a 45% annual cash flow yield. That's absurd. Markets don't let that persist. Either gold falls or the stock rises. Newmont, producing 5.8 million ounces at $1,512 AISC, would generate $3,543 per ounce in margin. That's $20.5 billion in cash flow against a $42 billion market cap, 49% cash flow yield. Those kinds of numbers force revaluation, period. So in the base case, I'd expect gold to deliver high single-digit returns, but mining stocks to deliver 30-50% returns as multiples expand. Bullish case, $6,200, $6,800 by Q4 2026. This scenario assumes Middle East conflict escalates, Iran-Israel direct confrontation or Strait of Hormuz blockade, or Trump announces aggressive tariffs triggering global trade war, OR Fed pivots dovish faster than expected, 75-100 basis point cuts by Q3, central bank buying accelerates to 951,000 tons, retail investor FOMO returns, driving ETF inflows to $60+ billion. Under this scenario, gold breaks out above the $5,600 high, consolidates briefly around $5,800, $6,000, then pushes towards $6,500. Mining stocks would go parabolic. I'm talking 100-200% gains from current levels. Why? Because at $6,500 gold, Barrick's margin goes from $3,768 to $5,113 per ounce. That's a 39% margin increase. But their cash flow doesn't increase 39%. It increases 80-100% because they have operating leverage and fixed cost bases. A company generating $25 billion in annual cash flow with a $32 billion market cap, that stock's going to $80-100 per share. It's at $24 now. That's what operating leverage does in a commodity bull market. Junior miners would do even better. Companies currently unprofitable or marginal at $4,700 would be minting cash at $6,500. I'm talking about 300 to 500% returns in 12 to 18 months. Now, what's the probability of this scenario? I'd put it at 25-30%. Meaningful, but not the most likely outcome. Risk case. $3,800, $4,200 by Q4 2026. This is the scenario that should concern you, not because it's most likely, but because it's possible. This assumes Kevin Warsh confirmed and signals genuine hawkish policy, 3 to 4 more rate hikes in 2026. Geopolitical tensions ease meaningfully, Ukraine ceasefire, Middle East de-escalation, dollar surges to 105 plus on DXY, Chinese speculative interest completely evaporates, ETF outflows of $20 plus billion. Under this scenario, gold retests the $4,000 level, possibly breaking below briefly to $3,800. Mining stocks would get hammered, down 30-50% from current levels. Barrick's margin would fall from $3,668 to $2,288 per ounce at $4,000 gold. That's a 38% margin decline. Cash flow would drop from $14.6 billion to $9.1 billion. Stock probably falls to $15.16. Junior miners? Many would be unprofitable again. Back to survival mode. Stocks down 60-70%. What's the probability of this scenario? I'd put it at 15-20%. Possible, but requires multiple negative catalysts to align. Most likely outcome. Here's what I actually think happens. Gold consolidates in a $4,500-$5,200 range for Q1, Q2 2026. Volatility remains high. $200, $300 daily swings are normal. By Q3, as the Fed's policy stance becomes clear and geopolitical tensions remain unresolved, gold breaks above $5,300 and ends the year at $5,400, $5,600. That's 15 to 20% upside from current levels. Mining stocks deliver 40-60% returns as institutional money rotates in and multiples expand from 14x earnings to 18 to 20x earnings. Junior miners deliver 80-120% returns as M&A activity accelerates and cash generation surprises to the upside. That's not a moonshot prediction. That's a logical extrapolation based on supply constraints, flat production, structural demand, central banks, investment flows, valuation gaps, mining stocks still cheap relative to underlying margins, historical precedent. Mining stocks always eventually catch up to metal prices. The math works. The fundamentals support it. The technical picture is constructive after this reset. That's the opportunity, not a guarantee, but a damn good probability-weighted bet. Now let me tell you why I could be completely wrong, because if you only listen to bullish arguments, you're not investing. You're gambling. So let's talk about what could derail this entire thesis. Risk number 1. Kevin Warsh is actually a hawk. Look, his history says he's a hawk. He opposed QE2. He warned about inflation in 2010-2011 when it wasn't a popular position. If he gets confirmed and immediately signals that rates are going higher, not lower, for an extended period, gold's in trouble. Higher real rates destroy gold. Period. If 10-year Treasury yields go to 5% with inflation at 2%, that's a 3% real yield. Why would anyone hold non-yielding gold when you can get 3% real return in government bonds? They wouldn't. Gold would fall to $3,500, $4,000 in that scenario. Now, I think this is unlikely because, 1, U.S. government debt is $35 trillion. Interest payments alone are $1.2 trillion annually. Higher rates for extended periods would bankrupt the government. 2, commercial real estate is already under pressure. Regional banks are fragile. Aggressive rate hikes would trigger financial instability. 3, Trump wants lower rates. Warsh is Trump's guy. The political pressure will be enormous, but it's a risk, a real one. Don't ignore it. Risk number 2, geopolitical tensions actually ease. What if Ukraine agrees to a ceasefire? What if Iran backs down and enters serious nuclear negotiations? What if China decides Taiwan isn't worth the economic cost? Peace is bad for gold. Stability removes the fear premium. If geopolitical risk premiums compress, gold loses $400, $600 per ounce easily. Now, based on what I'm seeing, this seems unlikely. Conflicts are escalating, not de-escalating, but it's possible. Trump is transactional. He makes deals. If he brokers peace in Ukraine or Iran, the market would celebrate and gold would suffer. Risk 3, dollar surges. The dollar is at 96.4 on the DXY right now. If it breaks above 105, gold faces massive headwinds. What would cause that? Fed stays hawkish while other central banks cut. Interest rate differential favors the dollar. Europe enters recession. Capital flight to U.S. safe haven. China's economy deteriorates further. Dollar strengthens relative to yuan. A strong dollar makes gold expensive for non-U.S. buyers. India and China account for 50% of global demand. If the rupee and yuan weaken significantly against the dollar, their purchasing power for gold decreases. That would show up as declining import volumes, which would pressure prices. Risk number 4, Chinese speculation was the whole story. This is the bear case that actually worries me most. What if the 2025 rally was primarily driven by Chinese retail speculation using massive leverage? We know Chinese premiums hit $121 per ounce. We know Shanghai trading volumes exploded. We know margin lending for gold futures in China was at record levels. If that leverage unwinds completely, the bid disappears. Chinese capital controls make it difficult to measure real-time flows. We're operating with delayed, incomplete data. It's possible that Chinese buying was 30-40% of the marginal demand driving gold from $3,500 to $5,600. If that's true, and if that demand is now gone, gold could consolidate or decline for an extended period. I don't think this is the primary story. Central bank buying is real. Western ETF flows are real. Indian demand is real. But Chinese speculation was definitely part of it. And that part is now reversing. Risk, number 5. Mining stocks are value traps. Here's an uncomfortable truth. Gold mining companies have a terrible track record of capital allocation. They destroy value through ill-timed acquisitions at peak prices, aggressive expansion into marginal projects, poor operational execution leading to cost overruns, management enrichment while shareholders suffer. Barrick's $7.7 billion Equinox Minerals acquisition in 2011 resulted in $4 billion in write-downs. Newmont's Goldcorp acquisition, still dealing with integration issues and underperforming assets. What if these companies repeat history? What if they blow their record cash flows on stupid projects instead of returning cash to shareholders? Then the stocks don't re-rate. They remain cheap forever. Value traps. The only defense against this risk is 1. Focus on companies with proven track records of discipline. Agnico Eagle, Franco-Nevada. 2. Demand management prove they've changed through sustained buybacks and dividends before paying premium valuations. 3. Diversify across multiple companies so one bad actor doesn't destroy your portfolio. Risk, number 6. Technical breakdown. Gold broke below $4,700 briefly. If it breaks below $4,500 decisively, technical traders will sell aggressively. The next support level is $4,200, then $4,000. In a technical cascade, fundamentals don't matter in the short term. Price action feeds on itself. I'm watching $4,500 closely. Below that, and I'd reduce positions temporarily until a clear bottom forms. Now here's the thing about all these risks. They're real. They could happen. I'm not dismissing them. But you have to weight probability. Is it more likely that Kevin Warsh destroys the U.S. financial system with aggressive rate hikes, or that he finds a middle path that avoids catastrophe while maintaining Fed credibility? Is it more likely that all geopolitical conflicts simultaneously resolve, or that tensions persist and potentially escalate? Is it more likely that central banks reverse course and start selling gold, or that they continue accumulating at elevated prices because the insurance value outweighs cost? When you honestly assess probabilities, the bullish case remains more probable than the bearish case. Not certain, but more probable. And in investing, you don't need certainty. You need positive expected value. The risk-reward at current levels favors the bulls, but only if you're prepared for volatility. Only if you can handle another 10-15% correction without panicking. If you can't stomach that, gold and mining stocks aren't for you. Stick with bonds. But if you can handle volatility in pursuit of 50-100% returns over 18 to 24 months, this setup is compelling. So here's where we are. Gold just experienced a violent reset from 5,608 to 4,668 in 4 days. $940 per ounce evaporated. Fortunes were lost. Margin calls destroyed over-leveraged traders. But the fundamentals haven't changed. Central banks are still buying 755 tons in 2026, $35 billion worth. Geopolitical tensions are still elevated. Middle East, Taiwan, Ukraine, Latin America. U.S. government debt is still $35 trillion and growing. Mining stocks are still trading at 14x earnings while generating record cash flows. The opportunity is still there. But time is running out for entry at these levels. Here's what I need you to do. First, if you found this analysis valuable, subscribe to this channel. I'm going to be tracking this gold story week by week, updating you on central bank purchases, Fed policy shifts, and mining stock opportunities as they develop. This isn't a set it and forget it situation. This is an active trade that requires monitoring. Second, leave a comment below with your gold price target for year-end 2026. I want to know what you think. Are you bullish, bearish, sitting on the fence? And more importantly, what are you doing with this information? Are you buying, selling, waiting? The community here is smart. I learn from your insights. Share your thinking. Third, share this video with anyone you know who's trying to understand what just happened to gold. The mainstream financial media is giving you surface-level analysis. Gold crashed because of Kevin Warsh. Okay, thanks for nothing. This analysis goes deeper. It connects the dots between central bank behavior, geopolitical strategy, supply-demand imbalances, and mining stock valuations. That's the level of analysis you need to actually make money in this market. Fourth, if you're serious about positioning in this space, here's my suggestion. Don't go all in on gold or mining stocks right now. Scale in. Start with 5 to 10% of your portfolio in gold exposure, either physical metal, ETFs like GLD or IAU, or high-quality mining stocks like Barrick, Newmont, or Agnico Eagle. Watch how the market behaves over the next 4 to 6 weeks. If gold holds above $4,500 and starts grinding higher, add to positions. If it breaks below $4,500 decisively, reduce exposure and wait for clearer technical support. This isn't the time for hero trades. This is the time for strategic positioning with room to maneuver. Fifth, educate yourself on mining stocks if you're going to play this space. Understand what AISC means, all-in sustaining costs. That's the true cost of production. Learn to read quarterly reports, production volumes, cost guidance, capital allocation plans. If you don't understand the business, you'll panic sell at the worst possible time. Knowledge is your edge. Use it. Now, a reality check. Everything I just told you could be wrong. Gold could fall to $3,500. Mining stocks could crash another 50%. Geopolitics could calm down. The Fed could stay hawkish forever. Central banks could stop buying. I don't think any of those things will happen, but they could. So manage your risk. Use position sizing. Don't bet money you can't afford to lose. This is a high conviction play for me, but conviction doesn't mean certainty. It means I believe the probability-weighted expected return justifies the risk. You need to make that calculation for yourself based on your own risk tolerance, time horizon, and financial situation. Don't blindly follow anyone, including me, into an investment. Do your own research. Validate these claims. Check the data. If it makes sense to you after independent analysis, then position accordingly. If it doesn't, walk away. No shame in that. The worst outcome isn't being wrong. It's being wrong at a size that destroys your capital. All right, we've covered a lot. Let me bring this home. Gold didn't crash because the bull market is over. It crashed because sentiment got ahead of reality, because speculators got over-leveraged, because algorithms amplified human panic. But while the weak hands were selling, central banks were buying. Poland, China, India, Kazakhstan, Brazil, adding tons while retail investors ran for the exits. They understand something that most investors don't. Gold isn't a trade. It's insurance against monetary debasement, against geopolitical chaos, against the loss of trust in paper currencies and financial institutions. And in 2026, those risks are higher than at any point since the 1970s. $35 trillion in U.S. debt, deficits at 7% of GDP, wars in Ukraine, the Middle East, potential conflict over Taiwan. A Fed chair nomination that creates uncertainty about monetary policy direction. These aren't bullish conditions for stocks or bonds. They're bullish conditions for hard assets. And gold is the hardest asset there is. So yes, the crash hurt. Yes, the volatility is scary. Yes, you might buy today and see it fall another 10% tomorrow. But 5 years from now, when gold is trading at $8,000 or $10,000 per ounce, when central banks own 50,000 tons instead of 36,000, when the dollar's share of global reserves has fallen to 45% from 58%, you're going to look back at 4,668 and think, I can't believe I had that opportunity and didn't take it. Markets don't move when everyone is ready. They move when reality hits. And reality is this: the monetary system is broken. Debt is unsustainable. Geopolitics are fragmenting. Gold is the only asset that's no one's liability. That survived every fiat currency collapse in history. That's trusted by central banks when they trust nothing else. This crash, this is your moment, your opportunity to position before the next leg higher. Don't waste it. I'm positioning, scaling in, buying quality miners at valuations that won't last. What are you going to do? Leave your answer in the comments. Subscribe for weekly updates on this story. Share this with anyone who needs to hear it. And remember, wealth isn't built by following the crowd. It's built by seeing what others miss, by acting when others panic, by maintaining conviction when fear dominates. The gold bull market isn't over. It's just getting started. See you in the next one.